Welcome to our 2024 webinar series. Throughout this series, we'll shine a light on three common client types that fee-only financial advisors often encounter. Follow the Green family as we illustrate the importance of lifetime insurance planning. We'll examine their risk factors and provide ways to safeguard their families and assets using personalized insurance solutions that can adapt to their changing needs throughout life. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We'll answer all questions at the end of the presentation. Today's presenter was recruited from one of the top disability insurance providers to be our second disability insurance specialist. Since 2015, he's helped many advisors and their clients not just with disability insurance, but also life insurance. Here to present on disability insurance is Brian Ciccarelli.
Thank you, Claudia. Welcome, everyone. It's a subject I love to chat about, and today we're going to be talking about protecting your income with disability insurance. So we're going to talk about what disability insurance is. We're going to go into a little detail regarding claims, and also we're going to talk about the policy design. What are the basics of the policy, what different types of policies there are, and how can we benefit your clients. So, what is disability insurance? It's basically a paycheck if it prevents your clients from working and earning an income due to a disability. So, it's also known as DI. A lot of people refer to disability insurance as DI, income protection, or also disability income protection. So, what are the chances of becoming disabled? I mean, you disabled? I mean, what are the chances? When I was early in my career in my 20s, I always looked at group disability options and trying to maximize my paycheck. And, I'm in my 20s, I'm invincible, I'm never going to become disabled. Oftentimes, I just passed up on the long term disability option because I didn't want to pay the premium. I just thought I was invincible. I really didn't need it. I was too young and too healthy. So, the chance of a disability are probably higher than you think. Just over 1 in 4 of today's 20-year-olds will become disabled before they retire. And what does that mean? That means they're going to be without a paycheck for at least 90 days. 1 in 4 of today's 20-year-olds will be without a check for at least a 3-month window. So accidents, this is something that I used to think about when it comes to disability. Someone's going to be in a wheelchair. Watch the news nightly. You always see some type of auto accident, and you could see how someone would become disabled. But it's not the accidents that are a majority of the claims. It's usually back injuries, cancer, heart disease, and there are other illnesses that are really the majority of the long-term disabilities. So, what are some of the most common reasons for claim? Musculoskeletal disorders is the highest, about 27%. Cancer, about 15% of claims. Injuries such as fractures, muscle spasms, sprains, falls, 12%. Mental health issues is a big one. Almost, between 9 and 10% of the claims are due to mental health. We'll also see a lot of exclusions when it comes to this area. The underwriters will definitely key in if you've had a mental health history. And also circulatory. So this includes like strokes, heart attacks, usually about 8% of the claims. Here's a snapshot. Two of the most common that we see. One is the mental nervous disorder. And this really covers anxiety, depression. Every once in a while we see schizophrenia. Drug, alcohol, and substance abuse are also part of mental nervous claims. Bipolar is one that we see. A little bit harder to underwrite that. Really depends on the severity of the diagnosis. Obsessive compulsive disorder. And then also when we talked about musculoskeletal, there's a lot of things that can be grouped into that category. Remember, it's about 27% of the claims. Arthritis is a big one. Rheumatism, scoliosis, osteoporosis, the fibromyalgia. Back pain's a big one. If your back hurts and you're unable to do work, some people could probably work with still having a back pain, but a lot of people would be out of their job and lose time at the office and money. So if you become disabled, what are your options? Uh, when I sat down with my clients years ago and we walked through disability insurance, it was just really painting a picture and identifying, what would happen to you if you were out of work, if you lost 3 months of income or more. So a lot of times they would say they would tap into a savings, they would tap into any investments they have, they'd ask their family, and working with an advisor, I mean, I could tell you probably most of your clients really don't want to ask their family for money, but that is one of the areas that many people would go to if they became disabled. They would have to sell some assets, right? It might be investments, it might be a vehicle or a boat, but they'd have to sell something in order to fund their monthly expenses. And then a lot of people think they'll depend on Social Security. The issue with Social Security, and there's several, is that the average payment is about 13.58 on per month on average. So, but the other issues concerning Social Security are the initial application. You become disabled, you can apply for it. It usually takes about 3 to 4 months to hear back from the Social Security Administration, and many people say that they're automatically almost declined the first time. I'm sure there's probably a few percent that may get approved at first, but most of the time, most everyone's a decline. Really, it could be between a 3 and 8 month window uh, to hear back from the initial application. So then you have to go through reconsideration. SSA denies the request. You have to file for reconsideration. That's another 3 to 4 month process while it's an initial appeal. Most of the time that gets denied as well. And then you have to go in front of a judge. And then the judge will look at it. And oftentimes, we're a year into this process, 2 years into the process. And what most people will do is they'll hire an attorney, and then the attorney will go in front of the judge, and that could take, and most people will say it takes about 3 years to get an approval for Social Security disability. So it's not something that we want to depend on for the short term. If you do get Social Security benefits, that's great, but it usually is a long window to finally get to that point. So, what's the financial impact of a disability? Here's Sarah, she's age 35, makes a good salary. You know, let's say that she becomes disabled for 3 years at age 40. What's the financial impact of that? When I would sit down with my clients too, a lot of clients like myself in my 20s, you talk about disability insurance and it just doesn't ring a bell. So some people are visual. So what I learned to do is, put up an example of someone's actual age or salary and show them an example of what would happen if they became disabled. And back then I had a software system like probably many fee only advisors too that would, give a projection based on, increases along the way and salary and savings model. So what I did here is something like this. So I would take Sarah starting at age 35, starting off with her income, and then all we go up to age, 30-year window here. This takes her to retirement to about 65 years old. And, if she's saving 15% of her income, taking 4% increases along the way, 7% rate of return, here we go. We get to about $3 million of assets at retirement, which is nice, and everybody loves to see this type of graph. But what I also do from a disability perspective, I'd throw in, what would it look like if there was a 3 month or 3 year disability claim where you're out of work for 3 years. So in this case here, this is just a chart that shows cash inflow, starting with her initial starting salary, 4% increases along the way. Her cash outflow, she's saving 15%. So between taxes and expenses, first year she was outflow of 106,000. And at the end of the year, after the 15% was saved, she'd end up with $20,000. Through the fifth year, um, she ends up with about 124,000 in savings, but she has a disability. So we take away her cash inflow for the next 3 years, and before the end of that first year, she's already used up all of her $124,000 asset build that she's had, and then she starts to go into debt. So in order to pay her expenses and her bills, and sure, she can maybe sell some things, or maybe not have as many girls nights, or you know you know getting her nails done, different things. There are way to pull back, but based on her spending, her current spending, you also have to consider in disability. If you're disabled, generally you have a lot more medical bills, and they add up pretty quick. So those are some additional expenses that people don't think about when it comes to a disability. But after that third year, we're looking at the eighth year here. She's already gone into $279,000 worth of debt just in order to pay daily living expenses. So the nice thing is, after the 3 years, she's able to go back to work. So she picks up her income, and then she starts paying off her debts. But if you look at year 18, it takes her to the 18th year, 10 years later, before she becomes whole again, because she got into $279,000 worth of debt. She's still saving her 15%. It takes her about 10 years to pay it back. And then, at the end of the day, I think a 3 year disability, if you look at the chart, it took her 10 years to bounce back to get whole again. And then at the end of retirement, 30 years later, she has about $950,000 in retirement versus the $3 million that she had she not had a disability. So even a short-term disability can have a major impact along the way. This is more of a visual type outlook when it comes to disability insurance. What I saw when I showed it to clients is it was much more impactful. Then they kind of understood a little bit more of the importance of having some type of coverage in place. So where can you get disability insurance? So for most people, they'll have a group policy through their employer. You can get individual insurance through LLIS or another broker. How about industry associations? This is one area when I'll suggest to a lot of advisors or clients, if they don't qualify for disability insurance through the traditional means due to either health issues or maybe occupation type, I'll outside the box thinking, I'll always ask them, look, reach out to your industry association. Sometimes they'll have different disability offerings out there that may be better suited for their occupation or their health needs. So always look at industry associations as well. And then obviously we talked about Social Security. Obviously Social Security is nice to have, but probably not the end all solution. So base policy design, base monthly benefit. It's basically the maximum amount of monthly benefits that a client would qualify for based off of their income and current coverage. It's really, determined by income and current coverages in force. This is the maximum amount a month they would receive if they went on a full disability claim. So the base monthly benefit, here's John, age 30. He's a pharmacist making $100,000 a year. He would qualify for roughly a $5,000 monthly benefit on a policy. And how we get to that point is we would take his $100,000 income, subtract the 60% of his salary, uh, and then we would subtract the amount of salary, and then he would end up qualifying for an additional 2160. And that $5,000 group salary is employer paid, so that's a taxable amount. So really, he's going to net about $3,750 from the group plus the additional individual coverage of $2,160. So different available riders that most fee-only advisors and clients are looking for, the professionals that we work with are looking for own occupation, residual disability, cost of living adjustments, catastrophic disability rider, and also the future increase option. And let's go into detail regarding each one of these. So the own occupation protects you in your own occupation. So if you're unable to work in your own occupation that you're doing today, it will allow you to collect full monthly benefits based on a disability in your own occupation. But let's say that you can do something else. Any monies that you make in any other occupation would be in addition to your disability benefit. So let's say that John goes out on a claim. He can no longer perform duties as a pharmacist, but he chooses to work. He's not being forced to work with the individual policy. A lot of group policies are going to force him to work elsewhere if he can or is educated to do it. But under the individual policies that we provide, own occupation allows him to choose to work if he wants to, as a consultant in this case, and any monies he makes consulting. So let's say he makes $80,000 a year consulting, that would be in addition to the disability monthly benefit he's receiving from his policy. So overall, it allows you to double dip. Allows you to get full benefits from your own occupation plus any monies in a new occupation. A lot of the professionals we work with, they want to have this language because often it's not included in a group policy. So residual disability rider, this is probably my favorite rider on the policy, and I say that for a couple of reasons. You know, I've been paying into my disability policy all these years. If I lose a portion of my income, I think it gives me the best opportunity to collect on this policy I've been paying in for. And I say that because I only need to lose about 15 or 20% of my income to be eligible for a partial claim. So let's say that John does go out on claim. He's still able to work part time, but he loses a portion of his income. The residual rider will allow him to collect a partial income, so not the full 2190 he qualified for, but partial. So let's just in general say he has the $5,000 monthly benefit. He's losing $2,000 a month of his income. He's eligible to collect because 2,000 is at least 20% of his income. John goes out on claim, a full claim for 2 years, and then he recovers again, right? So he's able to go back to work. So think about if he's out on the cancer claim, right? He may be out for 2 full years, and that at that point he's able to collect a full monthly benefit, the maximum he qualifies for. But let's say that he's able to go back to work, but being out for 2 years on a cancer claim, he may be able to go back into the office. But the nice thing about the residual rider is it allows him to continue collecting a partial claim. So this can happen at a front end of a disability. For example, maybe a ski accident, you lose maybe $2,000 a month. You can start collecting on a partial claim. And then it also works on the back end of a disability. So let's say that he's out on a full claim, such as the cancer claim. He gets full benefits, able to go back to work. But this residual rider will allow him to ease his way back into the office. And this is especially important for your clients who are dependent on commissions or dependent on monies that maybe take, 3, 6, or months to a year of working to be able to get paid those commissions down the road. So some positions aren't full money right away. It takes a while to build back up to that clientele level or that income level. So it works on the front end and the back end of a full disability. Wow. I mean, the prices these days, right? Inflation, eggs are expensive. I think a few years back they took a big jump, but they still seem to stay expensive, right? I think what I read recently was auto parts and auto repair is up like 30 or 40% over the past few years. Gas, right? We're all paying more for gas now. Was it like a few years back? It was $2 and some cents. Now we're looking at over three. I think the national average about 3.50 right now. So we can anticipate having inflation over the years, and there's a way to bounce against this or protect against it. So here we have a cost of living adjustment rider on a disability policy, right? So as the the cost of living adjustment kicks in after being on claim for at least 1 year. So the client is on claim after the first year, they'll pay a cost of living adjustment and increase the monthly benefit. So let's look at an example. So we talked about John going out and claim $5,000 monthly benefit. Cost of living after just 1 year, he received an additional 3% on top of his $5,000 monthly benefit. So his new monthly benefit after the first year on claim is 5150. So every year after that, they continue to add the cost of living adjustment. So after the second year, he's still on claim. So now he has a monthly benefit of 5305. So this is a 3% cost of living. Sometimes it's going to be more, the actual cost of living will be more, but this is helping John keep up with inflation so that his monthly benefits are increasing because he's no longer receiving raises from his job because he's not working. Cost of living adjustments great to have, especially for your younger clients. If your client only has 5 or 10 more years to work, it's probably less important than if your client's 30 or 35 or 40 years old and has the next 25, 35 years to work. Good benefit to have. Catastrophic rider. So this is, think about your worst case scenario of a disability, right? So this would include like loss of two limbs, hearing, eyesight, cognitive injury, um, similar to long-term care. You can't perform two of the six daily activities of living. Most of the claims are not catastrophic, but if they are, the cost and the medical cost can be exorbitant. So if you're familiar with long-term care claims, I mean, somebody could pay, $100, $200, $300, per day to have nursing care and to have other help coming in, cleaning, etc. So if you're catastrophically disabled, you are likely going to have a lot of medical bills. And this is the nice thing about the catastrophic disability rider. This is an additional benefit on top of your base monthly benefit to help cover additional costs. So let's walk through this. So John has the cognitive injury, medical bills are adding up, needs nursing care, and due to those injuries, he qualified for an additional monthly benefit of $3,500 a month on top of his base. And then, like long-term care claims, the catastrophic, as we mentioned, disability can be very costly. So having this rider is really going to help pay for those additional costs. So future increase option, great option to have. And most of the people who are applying are looking for this option as long as they can qualify for it. It basically allows you to purchase additional monthly income down the road as your income grows. The beauty behind this is that there's no medical underwriting. So initially, when you apply for insurance, you have to go through medical underwriting, financial underwriting. You have to get medical records if necessary. You may need lab work. The future increase option is great because no medical underwriting and locks in your health at the time of initial application. So if your client is age 30, likely more healthy than not, they get a policy. Even if they have health issues along the way, they can't hold it against them. There's no medical underwriting, just financial underwriting. So they can also take off anniversary uh, increases. And what I mean by that, so let's say that your client's a CPA working for a firm. He's a W-2 employee. He decides to go out and start his own CPA firm, right? So he goes out and he loses his group coverage. If he has an individual policy with a future increase option, uh, at any time that he loses that group coverage, he can automatically turn on additional monthly benefits to the maximum that he qualifies for. Another example would be an increase of income of 30% or more. He can automatically turn on those additional monthly benefits to keep his protection up with his income. So let's take a look at this. Here's John. He takes the future increase option. His income grows from 100,000 to 110,000, he can apply for an additional, or he can qualify for an additional $550 in monthly benefits. The advantages here are it's a short application with just proof of additional income. So a little bit of financial underwriting, short application versus the initial application that was several pages long. He had to go through the telephone interviews and the medical underwriting, the financial underwriting. This one's just a short process, which is very nice. Locked in his health a long time ago. Good option to have. So many times we'll get a call from a client or from an advisor saying that, you know, yes, this is a great idea. I'd like to have disability coverage, but it's just too expensive. It doesn't fit my budget. Or, and rightfully so, some clients will look at a policy and they've never had a policy before and they're not used to paying the premiums for a policy, and they just have a hard time moving forward with it. So, I mean, the policies that we quote and most fee-only advisors want are with the five riders that we talked about previously. But just know that there's always options out there for lower premiums. And let's take a look at John. So John came to us and said, we talked about, $5,000 monthly benefit, own occupation, residual, future increase option, cost limit adjustments, catastrophic riders, 90-day elimination period, which a 90-day elimination period basically is this self-deductible period or the self-insuring period. So by the time from onset of an injury or sickness, you would self-insure for the first 90 days, and then on the 91st day is when your benefits would start to accrue. So this is the premiums are going to be higher for this than it would be 180 or 360 days because you only need to wait 90 days before you start receiving benefits. Also, age 65 period is optimal for a lot of clients, especially if they're 30, 35, age 40. They have 30 potential years of working. If they go out on claim, an age 65 benefit period would pay those full benefits for the full 30 years as long as the client remained out on claim. So an annual premium is 2011 and probably not that bad for John making 100 or $110,000 a year. But let's just say John, was not comfortable with that premium. There's a lower cost option. And there's many things we could do to lower the premiums for the policy. One, we could look at lowering the monthly benefit. That's not my favorite thing to do because if John goes out on disability claim, regardless of what year, we want to make sure he has the maximum monthly benefit, but we could reduce that. But I ran another option, so I kept the full 5140 monthly benefit. I took away the catastrophic disability rider and the own occupation rider. So a little less richness, a little less rich in this policy. But once again, our goal here is to make sure that John gets a policy that works for him and still has coverage. It's just not as rich. We increased the elimination period to 180 days, and instead of that age 65 benefit period, we reduced it to a 10-year benefit period. And basically, what that means is that if John goes out on claim, there's a maximum 10-year benefit period per claim, right? So it's not going to go to age 65, but the 10 years is going to cover the average claim of about 3 years and then some. So in this case, we're able to get his premium down to about $990 per year. And I feel comfortable with it because we at least got John coverage and we're able to get him some coverage. It may not be as rich, but it's about half the premium. John's happy. The advisor's also happy that we have some coverage in place. So don't ever let the premium discourage your client. There are options. Please give us a call. We'll be able to walk through those options for you. So what determines the cost of disability insurance? Age. The older you are, the more expensive it is. Occupation. Risky occupation will pay a higher dollar per thousand. Safer occupations will pay less per thousand. Income obviously is a big factor. Male female rates is a big difference, and then also any enforced coverage that the client has. So that would uh, subtract the amount they would qualify for an individual policy. So let's look at occupational classes, right? So this is the lowest cost per thousand. Is going to be your CPAs, professional engineers, attorneys. 5A is going to be a CFP, IT professionals, executives. 4A, you'll see a lot of sales, analytical occupations, managers. 3A, oftentimes we'll see office workers, real estate brokers, pastors. 2A, bookkeepers, farmer, technician, and all the way down to A, baker, barber, bicycle mechanics. And these occupations also not only they'll have a higher cost per thousand, but they're going to limit the the riders available, maybe the benefit periods available. Uh, it's all based on risk, and so the higher claims experience, these occupations are going to pay higher premiums with limited policies. Even though it's limited and the premiums are higher, it's there's a greater chance an A occupation is going to go out and claim. So as long as we can make it affordable for them, they're better off still having a disability policy. So financial underwriting is part of the base monthly benefits, and then also including their special programs, our new professional program, retirement protection plan, and also student loan rider protection. And we'll go into a little bit more details in a few more slides on each one of these programs. But the financial underwriting eligibility is determined by income, so pay stub, taxes, and any existing or any individual policies in force. So when we look at existing group coverage, the group coverage might be less than the client realizes. And why is that? Uh, Typically, it does not cover bonuses or commissions. Uh, it's if it's employer paid, that means it's taxable. The employer writes it off. They take a tax credit. So at the time of claim, if they have a $5,000 monthly benefit, that will net a 3750 benefit after the client pays taxes on it. Group policies are generally offset by Social Security. So Social Security benefits, we did talk about it. It'll probably take up to about 3 years of getting it. But if you do get Social Security benefits, any monies you get from Social Security will generally offset the group monthly benefit. And it's also limited on the riders, including own occupation. There are some group benefits that have own occupation. A lot of them may be limited to 2 years, but oftentimes we won't see these rich riders on a group policy. So let's take a look at Sarah. As an engineer, age 35, makes a good living. She has a 60% to $10,000 employer paid benefit. She would qualify for an additional monthly benefit or an individual policy of 29.55. So with her 62.50, she'd receive from her group benefit, subtract the taxes, plus the 69.55, she will net about 74.33. It's really about 90% of her pre-disability net income. So it's really not that bad. We can usually get up to 90 some percentile of someone's income. The higher the income that someone receives, the lower percentage that the insurance companies will cover. So with the base monthly benefit of 29.55, here's Sarah 90-day elimination period. Benefits payable to age 65, own occupation, benefit, residual catastrophic, increased riders, a premium of 1508. So not a bad premium for Sarah. Financial underwriting when it comes to business owners. A lot of your clients are going to own a business of some sort. Um, it really requires a net income, really a tax returns for the past few years. Any K forms that they have, they'll look at as well. For a new business owner, they'll look at about 75% of someone's W 2 income. For example, let's say that the CPA we talked about earlier, he moves on from his W 2 job where he was making $150,000 a year. He goes to start his own company. He doesn't really have the financials of those 2 years of tax returns to prove his income. Uh, as long as he's moving from like occupation to like occupation, the couple of the companies will look at 75% of his last year's W-2. In this case, he was making 150,000. They'll underwrite up to 75% of that for a new policy, just because he doesn't have the 2-year tax returns to prove. It's nice to know that some of the companies will work with that individual and they'll be able to obtain disability coverage. So here's Harry. He's a CFP. He's age 35. He owns his own practice. He makes $200,000 a year in the past 3 years. He already has an existing $2,000 policy monthly benefit. He's eligible to receive an additional 7,410 of additional coverage. He had the own occupation, catastrophic, residual, and cost of living adjustment riders. His annual premium is 2727. So it's 9410 of in tax-free coverage and equals about $113,000 per year in annual benefits after taxes. So new professional programs, great program for certain professions, right? The insurance companies know that certain professions they're going to launch, right? So we're talking about dentists, doctors, CPAs, you know, different medical students. While they're residents, they're making a small income, but the insurance companies know that they're going to jump. So they've designed a program that they'll qualify for set monthly benefits regardless of their income or their group insurance. So they don't consider the group insurance. They don't look at their current income, and they also offer a graded premium option. And I'll show you an example in a minute of graded premiums. So, for example, a new professional program medical resident can get a policy of $5,000 monthly benefit. A pathologist fellow, you get a little bit more, up to about $6,500 a month. Cardiologist fellow, up to $7,500 a month. In the new professional program, they'll offer own occupation, residual disability, cost of living adjustments, catastrophic riders, and future increase options up to $14,000. So having this, young professional program, not only do you get the base $5,000 or $7,500 monthly benefit, but they'll allow future increase options of $14,000. And this is really setting your clients up for their first $300,000, $400,000, $500,000 of income because it's allowing them to buy future increase options and getting them close to about $20,000 of monthly benefits throughout the years. Also, student loan debt. We'll talk about student loan and how we can cover that, but the new professional plan will allow that rider as well. It basically covers the student loan debt. Especially someone who's in a medical career, someone who's been in a university or college for many years will come out of college with a lot of debt. This is going to help pay anywhere from $500 to $2,000 of monthly benefits, and it has to be on government or private loans. So you can't have Uncle Larry, have a $200,000 loan. They won't cover that, but as long as it's a government loan, they'll accept it, and it's a reimbursement model. So what you would do is you would say, you would submit your $1,000 student loan payment, and then they would reimburse you that $1,000 for the benefit. But it's nice to know that it's available, and a lot of parents who have helped their kids through college, we've had several parents inquire about this for their own kids and make sure they add the student loan rider to the policy. So Kevin, he's a cardiologist. He's making $90,000 a year. He's in a fellowship, and his group coverage is 60% up to $10,000. Without special limits, he would qualify. He'd be eligible for $1,900 a month because they would underwrite him as a cardiologist fellowship, making 90,000 a year with the group coverage. This is what anybody else would qualify for, not in the student or young professional program. So with the young professional program, he's able to qualify for a full $7,500 of monthly benefits, even though his income is only $90,000 a year. He'd have all the great riders and specialty owned occupation for his cardiology occupation. You have future increase options, which are important. Student loan benefit of $1,000. And we're able to get Kevin a policy for $2,028 per year. Now, previously, all the premiums I quoted were level premiums. A level premium for Kevin would be 35.31, and that means that from day one of the policy until 30 years later for that existing policy, the premiums would stay level. They don't go up or down. A graded premium is a great option for a student or someone who's not financially on their feet yet, right? A graded premium is offered at a lower rate, maybe was it 60% of the premium of a level premium, and then every year it gradually goes up. And most of the people that have a graded premium, after they get maybe 3 or 4 years later, after they're financially on their feet, they will transform it into a level premium or convert it to a level premium. Over the life of the policy, it's better to pay level, but as an example, as a student, it might be nice to have that graded premium option where it's low in the early years. So Kevin now, let's fast forward. He's now age 38. He's making 330,000. Remember we talked about he's going to launch. The insurance companies knew that. He has making 330. He also has a group benefit that's taxable. Uh, because of this, he's eligible for an off anniversary increase because his income jumped so rapidly. He qualified for an additional 3230, and that premium for that additional benefit was 1852. So now he has a total of $10,730 of individual tax-free benefit plus a 60% group. Retirement protection plan. This is another plan that if you go out on claim, right, and you stop working, you also stop funding your 401k or your simple IRAs or your investments. So there's an additional rider that would allow you to have additional benefits for retirement. Now, this is a benefit that is paid directly into a trust and in invested funds. The clients can choose them along the way, and then come at retirement, the disability payments would stop at age 65, and then at retirement, the client would have access to this trust and will be able to start pulling funds so that they can fund their retirement. It's a great option to have. So remember here we talked about our CFP. He has a policy, and he was able to add a retirement protection plan, a benefit of $2,000 a month, 180-day elimination period, age 65 benefit period, cost of living adjustments, and it was only an additional $615 to add to his individual policy, this nice benefit. Many people don't know this, but there's a multi-life plan option for your clients. So, a lot of people will come in and they don't like the premiums of policies, but a lot of them are also business owners, so they may have additional employees that may benefit from a policy. And this is basically working for the same company. As long as you have three individuals apply for disability policies, you can obtain a discount. So you don't have to necessarily apply at the same time, but once the three policies are issued, all the insureds, get a retroactive refund. And you don't have to remain at the same employer. Each one of those individuals could go on and do their own thing. And the discount that they get, which is a 20% discount on their premiums, which is very significant. So a 20% discount would also go with you and stay on your policy, even though you don't work for the company that originally set up the multi-life discount. So this is good to know. it can make a big impact. So, for example, here's Irene. She's a new graduate. She's a new dentist. She just graduated from dentistry school. She's making $150,000 a year. Her office does not have group coverage. So she would qualify for a policy and a benefit of $5,775 based on her current income. She would also pay an annual premium of $6,829. Now remember, her premium is higher because female rates, and the female rates at certain points, such as age 35, can be up to 70% higher premiums than male rates. Sounds unfair, but it's all based on claims experience. I know men, we pay higher for life insurance because we have a lower life expectancy. Women pay higher premiums for disability insurance. So this is one example where a multi-life discount could be very beneficial, right? So not only does Irene, the dentist, apply, but also her office manager and her dental assistant also apply for coverage. There's the three policies needed in order to get the discount. So the same $5,775 monthly benefit turned into a premium of 5,463 versus the 68.29 it would cost had she not had the multi-life discount. So big difference. So please keep in mind when you are working with your clients, and a lot of y'all have business owner clients. Mention to your clients, and we could always go back and we can entertain adjusting the policies so that we can reduce the premium. But this is one option also that maybe coworkers are also looking at disability insurance. The business owner could buy it on himself and a couple different employees, or offer the option to the employees. A 20% discount is huge for anybody, but also for a female dentist, uh, it would save her quite a bit of money as well. So LLIS, we're very active. We're at the different conferences this year. We're going to be at the Garrett Conference in August, ACP in October, XYPN Live in October as well, and also the NAPFA Fall Conference as well. So please look for us there. And what makes LLIS different? So many things make us different. We have free monthly webinars, CE credits, right? So upcoming in August, we have annuities, webinar. September, looking for your insurance policies and looking at optimal protection. October and November. November, we're looking at long-term care insurance. Please tune in for these. And also, what makes us different? So LLIS, we work with fee-only advisors, and we also have specialties in life insurance, disability insurance, long-term care, annuities, hybrids. We proudly sponsor NAFA Genesis, XYPN, ACP, BLX, Garrett Planning Network. And have you met Alice? Logging into our online portal, I get a lot of positive feedback from advisors. They're able to access their clients' policies. Before you have a review, please log in and you can access your client's policies, see what policies they have in force. You could also send us messages through Alice. We can submit quote requests. And one also thing I do a lot of, is policy reviews. So if you have a disability policy that you're not quite sure what it is or what the benefits are, or if it's even significant for your clients, please send it over. We'll be happy to review them. And not only, and I'll say this for disability insurance as well. 90 some percent of the policies I review, I will tell the advisor or the client to keep the policy they have, especially if it's been enforced for some time. Because if we're applying for a new policy to replace it, and it's been enforced for 5 or 10 years, the premiums are going to be higher today. A lot of times I'll mention to keep the existing policy, but if they need more, we can always help them get more coverage. And that also includes life insurance policies, a lot of different types of permanent policies, term policies, variable annuities. Please send those over to us. We're happy to review them. Annuities, long term care as well. Any questions? So we have a question here. It says, "What are the odds of being disabled for more than a year during a full lifetime of work?" Well, that's a good question. I guess it depends on the lifetime, but in the numbers uh, that I've seen, it's over a lifetime of work. So usually to age 65, usually there's about a 25% chance that someone will become disabled throughout their working years. Um, Over a lifetime, I guess that would be. I'm not sure if there is a number for that, but it's probably greater than 25%. Any other questions? Well, great. Um, I'd like to thank everybody for tuning in today. If you have any questions, please reach out to myself, Taylor, Kathy, anybody on a disability team. We'll be happy to help with any of your questions. Thanks for tuning in.